Hi and welcome again to another session of penny stock analysis, and today we're going to try something a little different, and we're going to talk about a trading strategy, not a stock and not a technical analysis tool, but a trading strategy, and that's brought to you by pennystockanalysis.com. Today our trading strategy is a simple one, hence the title. And we're going to use two technical tools that Penny Stock Analysis has taught you about before in previous sessions, and that is the rate of change and the relative strength index. Before we jump into the nitty-gritty of the analysis, let's just briefly recap exactly what the two technical tools are. So we have relative strength index. And what this attempts to do is determine when a stock is in an overbought or oversold position. It compares the magnitude of recent gains and recent losses, and it's an excellent tool for figuring out the entry and exit points, and will probably do so before any other indicator in your repertoire. The second tool in our stock strategy today is the rate of change. As the name suggests, it's a tool that's used to measure how fast the current price is changing in relation to a past price target. And the typical time period used is about 12 days. This is a price momentum indicator, not volume, price, and it can be used to measure long or short-term differences in price. Again, it all depends on the price target that you choose. And remember, what you're looking for here is divergence, as in if the price is going down but the rate of change slope is going up. That's what it's all about, is finding divergence. So on to the nitty-gritty we go, and you will see that there is the price chart on the top, the rate of change on the bottom, and finally on the very bottom section of the screen is the relative strength index. For now, we're going to concentrate on the rate of change. Now, everyone should see that there are blue arrows which point up and orange arrows that point down. So first, let's look at the rate of change chart. You notice there is a zero line, and essentially what that means is when the rate of change line is above zero, it means that the rate of change is positive. The price is moving upwards. And when it's below zero, it means the rate of change, or the price, is moving downwards. The higher, or it is above the line or below the line, means there's more power in that movement. So we can see with almost dead point accuracy that whenever the rate of change chart crosses above zero, as shown by the two blue arrows, if we look up, we see that the price goes up at exactly the same time. Conversely, when the rate of change arrows pointing downward, in other words, when the line crosses below zero, we notice on the top that the price of Ford Motor Company, which is the sample today, the price correspondingly heads downward. Now that we have taken care of analyzing the rate of change chart, we're going to move on to the relative strength index chart, which is located at the very bottom. And as we mentioned in the preamble to the charts, the relative strength index will more likely than not be your first technical indicator to signal when a stock has been overbought or oversold. In other words, a good entry point and exit point. So what we have here are green arrows that point up, or buying opportunities, and purple arrows that point down, in other words, selling opportunities. And with even more accuracy than the rate of change chart, we see that as soon as the relative strength index hits that 30 range, which is considered overbought, oversold, which is a good entry point, we see that the stock of a Ford Motor Company went up quite a bit. So in other words, in the first jump from 10 to 13, which is a very healthy 30% gain, and then the second time from about $11 all the way up to 18, which is another very healthy gain of about 60%. So even if you just use the relative strength index in this point, it would be very accurate in predicting when to buy and sell the stock. We are now moving on to our final chart of the day, which, as you may notice, is all of the charts combined into one single slide right here, and with all of the corresponding arrows up and down. And the whole premise behind using these two indicators together is that it provides a double confirmation for the trend that's happening. And in each period displayed here, the relative strength index was first to indicate a possible bottom, and then the rate of change typically confirmed it a week or two after, at which point they would be very good buying opportunities. And even if you bought when the rate of change chart said to jump in, you would make a very healthy return. So as we look at the price chart, we see first come the green arrows of the relative strength index to buy, then come the rate of change to confirm it. Then it's the relative strength index that says to sell, and the rate of change confirms it, and so on and so forth, all the way up to the highs of 1850. And so that's the whole premise behind this strategy. It's a double confirmation. And the other aspect I would like to bring your attention to is that between September and February on the price chart, in other words, when Ford makes that huge gain from 11 to 18, look very carefully at the rate of change between those buy and sell points. The rate of change just briefly, very briefly, goes below that zero line, but for 95% of the time, it's above zero. In other words, it's a positive rate of change. The price is going up. By the same token, as we look at the relative strength index, 50, which is often considered a resistance point, acts as a very, very strong resistance for Ford in this price. And all through that time, again, Ford never drops below 50. It always had very strong price support. And even when the rate of change dipped below zero, guess what? It found resistance at 50 in the relative strength index. And that's why it's very useful to use these as a double confirmation trading strategy. As we move on to our final thoughts, this sort of moral of the story and lessons of the session is that something we always iterate: using more than one method is often beneficial. In this case, using two methods of analysis is clearly better than one. And again, using these two analysis tools enables a person to, one, determine when a stock has been oversold or overbought, and it enables them to determine the strength of the price movement and if a true reversal has taken place. That's why you want the double confirmation. The RSI, because it moves so quickly with price, can often provide false signals, and that's why the rate of change is there to confirm. It acts a tad slower and works great in conjunction with the relative strength index. And that brings our analysis for today, our first trading strategy that we want to introduce you to. That brings our lesson to an end. But we can clearly see how using these two tools in tandem, the relative strength index and the rate of change, are able to provide you a double confirmation without losing any significant gains. And so that's why I would recommend the strategy, or at the very least, learning how this works and perhaps experimenting on your own. And of course, pass us along any questions at pennystockanalysis.com. And until then, invest wisely.